What is Forex? This is a question that definitely pops into your head. Immediately you hear the stuff like Forex, short for foreign exchange, refers to the global marketplace where currencies are traded. So Forex is actually coined from two words, foreign exchange, and it simply refers to the global marketplace, the marketplace where currencies are traded. Right? It is the largest and most liquid financial market where participants buy and sell various currencies based on exchange rates. It's the most liquid market in the world. It has about, currently, it's about $7 trillion floating in the forex market per day. All right, that's how liquid, that's the liquidity of the market. So traders, investors, businesses, and governments engage in forex to facilitate international trade and investment. So simply put, forex is the global marketplace where currencies are being traded. And the next thing we'll be looking at is what is forex trading? Forex trading involves buying and selling currencies on the foreign exchange market with the aim of making a profit. Now, this is it. This is forex trading. This is what we're looking at right now. It involves buying and selling currencies on the foreign exchange market with the aim of making a profit. Traders speculate on the future movements of currency exchange rates, taking advantage of fluctuations. Yes, this can be kind of related to those that are into crypto, kind of futures market. So traders actually speculate on the future movement of currency exchange rates. They kind of predict from analysis, predict the future move of the market, and they take advantage of fluctuations and make profit out of it. So the next thing we're looking at is who can trade forex. Hope you can hear ourselves loud and clear.
Mute the mic. Mute the mic.
Mute your mic, please. If your mic is on, if you just joined, try and mute your mic, please. Thank you for understanding. So the next thing we're looking at is who can trade forex. Now the forex market is open for individual retail traders. Yeah, please. Okay, so who can trade forex? First of all, individual retail traders, that's you and I, all right? Anyone can trade forex. Then institutional traders, that refers to banks, hedge funds, etc. Name them. So institutional traders are also there. They also trade the forex market. Then we have corporations. Corporations also trade the forex market, like the companies involved in international trade. They may use forex market to hedge against currency risk. Right. Then the next is the government. The governments also trade the forex market, like the central banks and governmental institutions. So the set of persons that actually so when it comes to the individual traders, anyone can actually trade the forex market. The next thing is when can one trade forex? Now this is in sections, alright? The forex market operates 24 hours a day, 5 days a week, due to the global nature of currency trading. The market is divided into four major trading sections based on different time zones. So, from this explanation, so are we following? If we're following, let's just hope I'm not too fast. All right. If we are following, just drop a notification. Just drop an emoji on the chat box, the general chat box in your Zoom. Just drop it if you're following up. Yes, I want to see it. I want to see. Yes, but please mute your mic if you just joined. Thank you. Welcome. So we're going to be looking at when can one trade forex. So, like we said earlier, forex markets operate 24 hours a day, 5 days a week, due to the global nature of currency trading. The market is divided into four major trading sessions based on different time zones. Like the first session that opens at Sunday night is the Sydney session. It opens around um, 11 p.m. for us that are in Nigeria, and this is actually the GMT time. So Nigeria is actually GMT plus one, so it's 11 p.m. for us, right? That's the first session, Sydney session. Then the second session, that's the Tokyo session. The third session, that's the London session, and the New York session. So these are the time frame. These are the categorized sessions of forex trading. This is when we can actually trade the forex market. Next, we will be looking at the terminologies associated with forex trading. So we say the following are some of the terms we can't do without regarding forex trading. Meaning, immediately we say we want to trade forex, these are terms we will definitely come across. All right. So we're going to be looking into those terms and know their meanings and everything. So the first thing we're having on the list is a broker. So what is a broker? A broker in forex trading is a financial institution or an individual that facilitates the buying and selling of currencies on the foreign exchange market. Now, let me take that again. A broker in forex trading is a financial institution or an individual that facilitates the buying and selling of currencies on the foreign exchange market. Now, for example, remember we said a broker is a financial institution or an individual. For instance, look at the aboki by the roadside somewhere. Most times they you can see them around outside banks or places like that. But you see that aboki changing dollar or other currencies is actually like he's functioning as a broker. He is a broker, all right? Probably you take your dollar to him, he will, based on the current exchange rate, he will now give you naira. So now he's changing. You guys are actually trading naira to USD. That's the transaction going on. So it could be a financial institution or an individual that facilitates buying and selling of currencies on different exchange market. So brokers act as intermediaries between retail traders and the forex market. Now, when we're looking at broker as financial institutions, they what? They act as intermediaries, as middlemen between retail traders and the forex market. Little bit. Okay, okay, okay. I saw a comment. Someone said a little bit fast for newbies. Okay, we'll take it gradually. All right, so everyone can follow up. Yes. Video, and also the video is being recorded and is going to be uploaded after the class. So you can actually go through the video again to understand more better. All right, but I'll try as much as I can to be um, a bit slower and so we all can follow through. So I believe the broker aspect is clear now. Just is a financial institution or an individual that facilitates the buying and selling of currencies on the foreign exchange market. Remember, the brokers looking at the financial institutions, they act as intermediaries between retail traders and the forex market. The next thing we're going to be looking at is the key functions of a forex broker. Now, these are basically the functions of a broker. One, we say is it provides a trading platform. Yeah, looking at the financial institutions now, they provide a trading platform. Secondly, they facilitating transactions. When it comes to we taking trades, the broker actually triggers, they actually take our orders, probably buying or selling. All right. Then they offer leverage. They offer leverage in the sense that okay, later we're still going to talk more about leverage, but they offer leverage, meaning let's say if you have $100 and if a broker is offering leverage of 1:100, they are actually giving you more buying capacity. All right, that's the meaning of leverage. They are giving you more buying power. All right. Now, one other function of the broker is they also provide market analysis and research. Now, these days, if you notice most of the brokers, if you register with them, they do send you probably from every forex trading day, they do send you their view of market analysis. All right. So they also provide market analysis and research. Oh, you're welcome. Please, if you just joined, try and mute your mic. Let's mute our mics, please, so we can hear ourselves clearly. Yes, please mute your mic, ma'am. Hello, ma. Please mute your mic. Okay, I think it's better now. Thank you so much for understanding. So these are the functions of a broker, right? They provide trading platform, they facilitate transactions, they offer leverage, and they also provide market analysis and research. These are some of the functions of a forex broker. Then the next thing we're going to be looking at is leverage. Okay, thank God we just got to it. Now, leverage in forex trading involves using borrowed capital to increase the size of a trading position beyond what would be possible with one's own capital alone. Now, let me explain that. Like we said earlier, looking at the functions, one of the functions the broker provides, they offer leverage. All right. Now, leverage in this example, let's take the example so it will kind of be easier for us to understand the explanation. It is expressed as a ratio such as 50 is to 1 or 100 is to 1, indicating the multiple by which a trader's position size can exceed their margin deposit. Now, let me explain that. For example, let's say you funded your account with $1,000. If you fund your account with $1,000, you know the forex trading it actually do its margin trading, right? And that $1,000 may is not enough for you to probably trade kind of a huge lot size. Trust me, all right? Because for example, if you let me not go too deep for now for the sake of the newbies, but that $1,000 is actually not enough to take a good lot size. All right. So what the leverage does for retail traders is, but for example, let's say a particular broker is offering 1:100 leverage. All right. So for example, let's say we are retail traders. 1,000 is not too big, but let's go with $100 now. If you fund your account with $100, and if the broker is offering 1:100 leverage, that your $100 will have a buying capacity of $10,000. Now let me take that again. Now the ratio of the leverage they are offering is 1:100. So your $100 will be multiplied by 100 because of the leverage. So now you have higher chance of placing bigger positions in order to make more profits faster. I don't know if it's clear. Let's if it's okay, there will be room for questions. So, but let's just pay attention to it. This is it. The leverage actually gives us more buying power. With the leverage, you can actually buy more at a time. So that's what it helps us do. All right. So indicating the multiple by which a trader's position size can exceed their margin deposit. We also say leverage in forex trading involves using. Oh, okay. I guess that's a duplicate copy. Now, the next thing we're going to be looking at is equity. Now, equity in forex trading refers to the current value of a trader's account, of a trader's account, yes, taking into account open positions, profits, and losses. Now, equity is calculated as the total account balance plus or minus any unrealized profits or losses from open positions. Now, let me explain before, okay, with the mathematical equation, I think it's going to make it easier. Let's look at the equation. Mathematically, equity is equal to your balance, plus floating profit or loss. Now, let me explain that. Let's say you funded $1,000 and you have a running trade. You've taken trade and your trade is running in $100 profit already. Even though you've not closed the trade, your balance is going to be having, you're going to be seeing it written up there, 1,000. But your equity, you will see your equity to be 1,100. Now that 100 is actually the floating profit. That's the trade you have running. So now equity is simply your account balance plus your floating either profit or loss. So in this case that we assumed is $100. Okay. In this case that we assumed you are already having $100 profit, it actually means equity will add up your balance and your running position, alright, that you have $100 profit. Now for instance, let's say you were the running trade, you are actually at loss, alright. So if you are at loss, let's say you're losing $100, same $100, alright, while you funded $1,000. So in your balance, you're going to see 1,000 there, alright. But in your equity, you're going to see $900 because you are having a floating loss. I think this is clear enough. The equity is just adding addition of balance plus floating profit or loss. Okay, now let's go to the next one. The next one we'll be looking at is the ask and bid price. Now, in forex trading, the ask price refers to the price at which a trader can buy a currency pair from a market maker or a broker. I'm going to keep it simple so we can understand it. The both of them actually work together. You are always going to see them together, all right? But you'll be able to differentiate the both of them. It's very simple. So the ask price refers to the price at which a trader can buy a currency pair from a market maker or a broker. Then the bid price refers to the price at which a trader can sell a currency pair to a market maker or a broker. All right. So now we are going to look into that. All right. Either this evening, if time permits, or tomorrow morning. We'll see how we'll schedule this stuff. Because I notice most persons have not gotten the Profem account. So we're going to give time at least throughout this night for um, individuals to be able to register the account so we can see if we'll activate the account tomorrow, even though we're not supposed to have class tomorrow. So now looking at the ask and bid price, if you open your trader, when we go there, we're still going to explain more of this, right? But it's very simple. You will see two lines, probably basically on red line and the blue line, all right. You see them always moving together. They have little space in between them, all right. We're also coming to explain that. So the ask price is the line at the top, all right, and the bid price. Now we're talking about current market price. If you see a market running, there are always two lines. Whenever it's currency pair, there you see two lines, and the top line is the ask price and the one at the bottom is the bid price. So the top one, the ask price, if you buy, let's say you are longing a trade, a particular currency pair, you are longing a trade, um, your position, your order will be placed at the ask price, all right? Then let's say if you're shorting, your order will be placed at the bid price. So this is how the both of them work together. We're gonna have more practical classes so we'll understand better. Now the next thing we'll be looking at is the spread. Now the spread is the difference between the bid price and the ask price of a currency pair. Alright, so like we explained just now, when you see the ask price up there and the bid price below it, there is a little space in between them. Now this is called the spread, alright, and the spread is actually it represents the transaction cost for entering a trade and is essentially the broker's profit.
End on this and continue.
Okay. Then what do we do to the other interval?
Yes. You know they want to know. They will get tired. Yes. This is about playing. What?
Okay, guys. So talking about the spread, it's actually the difference between the ask price and the bid price. So if you've been following up to this extent, please drop an emoji on the chat box. Just drop it. Let's see. Let's be sure that we all are going together. Just drop an emoji on the chat box if you've been following up to this extent. Please, please mute your mic. Please mute your mic. If you're following up with everything we've been discussing, you're getting it, yes. Just drop an emoji on the chat box. Let's be sure that we all are following up.
When it's don't long. All this thing, the long is always in place. I'm not sure you understand the question.
Okay. Um, I think even though we said we're going to open the question and answer group for people to ask their questions there. I think let's just have a little discussion class. So if you're having any question based on all we've discussed, if you're having any question, just drop it on the chat box. Let's see. Or you can ask your question. Just raise your hand, signify, then we will call you up to speak. If it's going to be very clear, you will tell us, you ask us your question. If you're having anything to add, just yeah. So if you're having any question, just raise your hand. Just signify by raising your hand. So we'll call your name. You can ask your question. Hello, are we following? Are we together? If you're having any question, just ask your question now. Does that mean we are all clear with everything we've discussed so far?
Okay, clear.
Okay. Sir Henry said clear, so we are good to go. Anyone else? Any question you're having? Okay. The Amaxi said we all clear over here. So okay. Okay. Sir Benjamin also said clear. Okay, I think
Continue. Continue.
hmm.
Yes.
Okay. So let's continue. Let's move on from here. So the next thing we'll be looking at is okay, we've talked about the spread. So we'll be looking at currency pairs. Now, a currency pair is a pairing of two different currencies representing the exchange rates between them. It shows how much of one currency is needed to purchase one unit of the other currency. Each currency pair consists of a base currency and a quote currency. Now, let me explain this. A currency pair, definitely, if you want to trade Forex, remember it's foreign exchange. It has to involve two currencies. Probably, maybe, like the example we cited earlier on, you're actually trading dollar for naira, right? So you're actually giving them dollar to give you. So it must involve two currencies. If it is currency pairs you want to trade, it must involve two currencies. So, for example, in the currency pair, euro against USD. Remember, we also the definition says it shows how much one currency is needed to purchase one unit of the other currency. Now, if we look at, for example, say the euro USD, the EUR represents the euro, all right, the euro currency. Then the USD represents United States dollar. So in this pair now, this particular pair, euro USD, the euro is actually the base currency. The USD is the quote currency. What the base and the quote simply mean is that um, the quote currency, all right, actually determines how much of the quote is needed to be equated to the base currency. Now let me explain that. Now, 1 euro, the euro is actually higher than dollar right now as we speak. So 1 euro is equal to around 1.1 something dollar, 1.2 something dollar, 1.3 something dollar, depending on the current market price. All right. So now for the euro USD market, let's say for instance, let's quickly look at this. Let's quickly let's look
Close
at
with
this.
this. Close with this.
Okay. For instance, let's take a practical stuff so we can understand what we're saying. Now let's look for Euro USD. Euro USD. Guess I don't have it here. Let me put it here. Euro USD. Where are you? Okay, this is it. So now let's say Euro USD is the one down here. This is the pair, all right? Euro USD. I hope it's clear for everyone to see. Yes, that's the one in the box down here. That is Euro USD. Now, currently, the price for the price of dollar needed for it to equal €1 is actually $1.08. All right. So 1.08008 dollar equals €1. So in all the pairs you're seeing now, the base currency is actually the currency that comes first. All right. Then the quote currency is the second currency. So the figure you're seeing, all these figures running, later on we're going to come to more practical stuff about the ask and the bid price. But these figures running are actually a unit. That is, this figure is actually equating to 1 unit of the base currency. All right. For example, up here we are having AUD NZD. That's the Australian dollar against the New Zealand dollar. That's this. Talking about this one up here now. This one up here is AUD NZD. All right. So what figure we have here is that 1.0695 of New Zealand dollar is needed to equate to the Australian dollar. So this is basically how the currency pairs work. They are always in twos. We trade in twos. I guess this is clear enough. Let's go back to let's go back to so this is the explanation for it. The base currencies, it always comes first, all right? Then the quote currency is the second currency that comes alongside. So in this case, for this Euro USD pair, the Euro is the base currency and the USD is the quote currency. So I think we've come a long way and we're going to close for today. Now concerning the fact that a lot of us have not um,
I am not clear on the currency.
okay, I'm seeing a comment from Abidege says it's not clear on the currency pair. Okay, then I think we should take that again before we close. Now, currency pairs. Okay, you can get the definition alright, but let's explain so that the newbies can also understand. The currency pair, remember we said if you're going to trade, forget about the market now. Let's look at the aboki man by the roadside. Let's say you were like in last election, I noticed they shared dollar in our state there, Bayelsa. So now all those persons that packed those dollars now, you can't actually buy things with a dollar in the normal local shops we're having, all right? They will only accept the naira. So what you need to do is you actually take that dollar to a broker, probably an aboki by the roadside, all right? Or probably maybe if you want to change it in the bank. So you take it to them. They will looking at the current rate they are willing to offer you, all right? Let's say then it was around maybe 65,400 dollar. That means 650 per dollar or 700 per dollar. So they will now exchange. They will now take your dollar and now give you the naira that you need to for your day in day out purchase of things and all that. So when it comes to currency pairs, two currencies are always involved. All right, two currencies are always involved. It's either you're buying one to sell the other or you are selling one to buy the other. That is how it works. So when it comes to forex trading, now the brokers online offering the trading platform, you might not actually be buying the maybe euro USD you're trading, you getting the cash of the currency, all right, but you are actually trading the fluctuations among in the market space, in the global market. You're actually trading the fluctuation, predicting the market and making profit out of it. So currency pairs will always involve two currencies. Ebidiege, is it clear enough now? Please signify if it's clear now.
Oh, what is the question?
What he needs is to know which one is the base and which one using that your naira and USD now.
Okay.
You understand?
Okay. Now,
That is
Ebidiege, please signify if it is clear enough, or there is
clear.
not
Very
still
important.
signify. But remember, we said whenever it gets to a currency pair, the the first currency you're going to see is always the base currency, all right? And the second one is the quote currency. Now, for instance, let's say you want to trade um, NGN USD. NGN, that's Nigerian Naira against the United States dollar, all right? NGN USD. Currently, I've not checked their markets today, but looking at let's say P2P price, it's going to be around 1,200 thereabouts. All right. So if you're trading NGN USD, the exchange rate will be around 1,200, meaning 1,200 naira. Sorry, yes, 1,200 naira is needed to equate $1. So that's how it works. So that's how the fluctuation of the exchange rate works, and forex traders actually make profit out of it, either from the buy side or from the sell side. Are we clear? Is it clear enough? Ebidiege,
A
is there
bit
any
clear.
comment here?
A bit clear.
Okay, a bit clear. Okay. I think if you go through the video again and again, you're going to understand better.
So which one is equal to naira? You understand?
Ah, yes, I understand.
Okay,
Now,
kindly explain.
okay, 2 minutes, me says
Meeting has closed.
40 minutes.
40 minutes. Okay.
Telling you about time.
Okay, see.
Should I start another one and drop
No,
it?
no, no, no. We are done already.
No, you
We'll
can't go
just
like that.
No, now come back to the group. The main lecture is done now.